I, Professor B.K. Jain, Dean, Byani Institute of Science and Management of Byani Group of Colleges, welcomes you in this lecture series. Today's topic is commercial bank, and in lecture series, this lecture is at number 3. Before coming to commercial banks, I would like to briefly mention different types of banks operating in our country. To start with, on top we have country's central bank, which is known as Reserve Bank of India. It is not only country's central bank, but it is also a bank of central government, a banker's bank, and a lender of last resort. Then we have cooperative banks. They also have a very long structure consisting of short term, medium term, long term, and the entire structure is connected with primary levies with PACs at the lowest level, and then we have district central cooperative bank, state cooperative bank. In the field of long term structure, we have state land development banks, then primary land development banks, and then farmer. So next is development banks. As the name indicates, these are the banks which have been specifically created at national level and have been assigned the responsibility of developing a particular sector of economy. In the development banks, prominent name which I would like to mention is NABARD, which has been specifically created for developing agriculture as well as India's rural development. It has been assigned the sole responsibility of developing both these sectors, that is agriculture as well as rural development. Then we also have banks which are known as investment banks. These are the types of institutions. In fact, they are not exactly a bank in the right sense. They are those institutions which collect money from public, and then they have huge surplus, and that surplus is being invested, and that is why they are known as investment banks. I would like to make a mention of the biggest investment bank of our country, which is known as Life Insurance Corporation of India. It deals with insurance business, and it has regular income of insurance premium, and that is why it has huge surplus for investment. The income is, or the surplus is very heavy because the insured people continue to pay their premiums. Premiums go on accumulating, and they get amount only at the time of maturity or at the time of untimely death of the policy holder. Now I come to commercial banks. These commercial banks can broadly be divided into two parts. One are known as scheduled banks, others are known as non-scheduled banks. In fact, scheduled banks are those whose name has been included in the third schedule of RBI Act 1934. Sorry, not third, but second schedule of RBI Act 1934. These scheduled banks are generally reputed banks, and they are working in profit. They are not acting in any way detrimental to the interest of depositors. Non-scheduled banks are those who has not been included in the second schedule of Reserve Bank of India Act 1934. Now in very brief, I would like to explain the broad classification of these commercial banks. All the commercial banks in the country can be classified into three parts. One are known as public sector banks, others are known as private sector banks, and third category is known as foreign banks. Now under public sector bank, let me very briefly explain what exactly the public sector needs to be explained, and this is where the share capital of government is more than 50%. That is, public owns these banks, and that is why they are known as public sector banks. I once again repeat, the government share capital or share capital of the public is more than 51%. These public sector banks can also be classified into three parts. One are known as nationalized banks, other is known as Sbi Group, and the third is known as regional rural banks. In all the three types of banks, the share of government is more than 51%, and that is why this group is known as public sector banks. Now the first are the nationalized banks. Let me very briefly explain what is the word nationalization means. In fact, nationalization means that the banks were earlier owned by private people, but finally government took over them so that these banks could function in the manner government wants to function. In fact, earlier they used to provide money only to their owners, to their relatives, friends, etc. But they were not prepared to lend money to poor people. And government was very much interested that their deposits should ultimately go in the lending of poor people, so that poor people can be brought under the mainstream of country's economic development. Now, under nationalized banks, we have two groups. 14 major banks were nationalized in 1969, and another 6 banks were nationalized in 1980. So the number went up to 20. But one bank, that is New Bank of India, was merged with Punjab National Bank, and that's why the number came down to 19. One bank under the nationalized bank was added, that is IDBI, in 2007, and then one more bank was added, known as Mahila Bank, in 2003, and then we have 6 banks which are known as SBI and their subsidiaries. Now, in all, today there are 27 public sector banks in the country. I once again repeat, these are the banks which are owned by Government of India. You might have seen their board on their buildings of the banks, owned by Government of India. The next group of public sector bank is SBI Group. Now, on the top is the State Bank of India, which is the main bank, and then earlier its 7 subsidiaries were formed, but 2 subsidiary banks were merged with the State Bank of India. These are the State Bank of Indore and the State Bank of Saurashtra. Now we have SBI plus 5 subsidiary banks, and these subsidiary banks are State Bank of Bikaner and Jaipur, State Bank of Patiala, State Bank of Mysore, State Bank of Hyderabad, and State Bank of Travancore and Cochin. Now, a policy decision has also been taken, but it has not yet been implemented, that all these subsidiary banks would be merged finally with the State Bank of India. Rumors are also going on in the newspapers that Mahila Bank is also going to be merged, but no final decision has yet been taken. The next group of public sector banks are regional rural banks. These banks have been specifically created in the year 1975 under RRB Act, and the purpose is to supplement the efforts of commercial banks as well as cooperative banks in rural lending and rural financing. They have been specifically created to supplement the rural development targets of the entire banking sector. Now, in these regional rural banks, 3 partners are state government, central government, and a sponsored bank. And in all these 3, state government is providing 50% of share capital, central government is providing 15%, sponsored banks are providing 35% share capital. So the share contribution in these public sector banks of a state, central, and a sponsored bank is 50, 15, and 35 ratio. Now, another very big group of commercial banks belongs to private sector banks. These are, as the name says, in which these share capital belongs to private people and private organizations. And we have well-known banks in our country. On the top is ICICI, and then next is HDFC, then we have Axis Bank, then we have Kotak Mahindra Bank, and there is a long series of banks in this private sector. But all these banks, public sector or private sector, these are controlled by 2 main acts. One is known as RBI Act 1934, and the other is known as Banking Regulation Act 1949. Irrespective of the type of bank, the RBI has power to control these banks through these 2 acts. I once again repeat, RBI Act 1934 and Banking Regulation Act 1949. Now, the third group of commercial bank is known as foreign banks. All these banks are having their head offices outside India in foreign countries, but they have been permitted to open their branches in India. Whenever the branch is opened, they are subject to regulation by country's central bank, that is Reserve Bank of India, and both these acts again apply on these institutions, that is RBI Act and Banking Regulation Act. Now, all this group of commercial banks perform very key functions, and these key functions performed by them, number 1 is they accept deposits. These deposits again may be of various types. For example, SB, then current, then fixed, then recurring, etc., etc. So they accept money from public through different types of deposits. Another key function is that these deposits are used for the purpose of advancing loans to the public or to the needy. Again, loans may be of different types, may be secured, unsecured, then housing loan, education loan, vehicle loan, etc., etc. There is a long list of purposes for which loans are being advanced. Another important function these banks perform are investment of their surplus money, and these investment is made by the commercial banks in various purposes. These investments can also be classified as statutory investment and non-statutory investment. Statutory investments are those which are required under RBI Act and BR Act, and then non-statutory are those whose power of investment remains with the banks. They also perform various functions, and one of the important function is agency function. Agency function means acting on behalf of their principal. Customer is generally principal, owner, and bank works as agent. On behalf of customer, it performs various functions like accepting their money for collection, payment of various types of dues on behalf of customer, insurance, etc., etc., etc. Then they also performs various general utility function, and in general utility function we can make a mention of locker facility, etc., DD facility, etc. Then they also perform foreign exchange function. Banks perform this function with the prior approval of the Reserve Bank of India, because Reserve Bank of India is the sole authority to deal with foreign exchange. And lastly, the bank also perform credit creation. In fact, credit is many times more than what money in circulation is, and one of the important function of RBI is to control credit so that there is no inflation in our country. Thank you, and thank you.